for inflation, real rates are beginning to move up and tip. Bill George, you have been here before as a corporate officer with Medtronic. There is a consensus opinion as an executive, all your radar's got to go up against a consensus opinion of higher interest rates.
Well, I believe in having adequate liquidity. We wouldn't have had the financial crisis 5 years ago if the banks had adequate liquidity. But I think Verizon really has neck stuck out, still does, with a $160 billion deal. And it's a good thing they were able to float this offering, even at a high yield.
But as a corporate executive, the window is closing here.
Yeah, I understand.
Low rates and all of the QE purchases of treasuries and mortgages, so it's time to make a move.
Yes, I think treasurers are trying to get in on it, and I think they should. Like I say, you don't want to be caught short with too much leverage and no liquidity.
Yet at the same time, those who bought into Apple's bonds still have been losing money. So for investors, could this be seen as a bet that interest rates are not going to spike from here on out, Bill?
Yes, it could be. Investors are looking for a safe haven. They got to find some money. The stock markets have been a great place for it,
right,
but they seem to be tapering now.
And you wonder what the equity return will be with Verizon with that 10.4% annual yield. Here's the backstory. This is brand new. Like the ink is on my fingers. The ink is dry. Hank Paulson, of course, will talk about this on Bloomberg Surveillance and also Bloomberg Television and Radio today. His look back 5 years. Judd Gregg, I look back, and if I'm a viewer, a retiree, barely making low interest rates, this is once more the fat cats. What is it, Scarlett? $250 million in fees? Just on the bond deal?
All the bankers will certainly get paid, but if you bought into this, a 10-year bond at 5.19%, 57 basis points higher than existing debt with that maturity.
Is this, Senator Gregg, about the fat cats making money where retirees make nothing at the bank? I mean, that's simplistically the way the public looks at this.
Well, I think it's inaccurate if it is. Basically, this is about the markets actually working. The company that needed cash in order to do a major deal came to the markets and got cash at a premium, paying a premium for it. And folks have a chance to participate in that through their investments. And this is just the beginning, in my opinion. I think the markets are getting back to a normal state after 5 years of significant retrenchment and fear.
It was amazing to stand on the Cantor desk yesterday and watch the buzz of five guys dealing with the phone flow.
Yeah, this is certainly a litmus test, a successful one if you want to look at it, on the corporate credit anxiety before this anticipated Fed tapering.
Well, before this anticipated Fed tapering, Bill George, do you expect to see more deals, more spin-offs, more mergers as a result of this window closing?
I do, and as an investor, I'll take 5%. I think Judd's right. The markets are working, and I think that's exactly what we want to have happen.
Yeah, but it's a fine line between working and distortion.
Well, I don't see this as distortion. I think there's plenty of liquidity out there, and I think, who knows where interest rates are going. Everyone's been predicting they're going to go up, and so far they've stayed.
But that's the key emotion here. The chief financial officer of Verizon said, guys, let's get this done.
I would say the same thing if I were a CFO. Right now, move into the market, take advantage of the opportunity. You don't want to be shut out. Remember the credit crunch 5 years ago when the market
I want everybody to point out this conversation would not happen in Europe.